Okay, so the next theory that we are going to discuss is the tax preference theory. This is the third theory that we are discussing. The tax code actually encourages many individuals to prefer capital gains to dividend. Dividends are taxed more than capital gains, and taxes on capital gains are deferred. So I'm going to open a note for this. So basically, your return comes in the form of dividend or capital gain. Now you need to understand how does taxation work over here. Dividend, the tax on dividend is paid every year or whenever dividend is given. बेसिकली जो डिविडेंड है उसके ऊपर जो टैक्स है, अगर डिविडेंड हर साल पे हो रहा है तो उसके ऊपर हर साल टैक्स लगेगा. वेयर एज कैपिटल गेन, अगर कैपिटल गेन में टैक्स कैन बी deferred. टैक्स कैन बी deferred मीन्स दैट कैपिटल गेन पे तब तक टैक्स नहीं लगता जब तक आप उस रिटर्न को रियलाइज़ नहीं करते. विच मीन्स दैट स्टॉक की प्राइस 1000 है, ठीक है. सो आपने कुछ स्टॉक्स ख़रीदे हैं 1000 के, उसकी स्टॉक प्राइस 1200 हो जाती है. This is a capital gain of 200, लेकिन this is not a realized gain because you didn't sell your stocks at the price of 1200. आपने stocks अभी तक बेचे ही नहीं. जब तक आप stocks बेचोगे नहीं, return realize नहीं होगा. Similarly, if the stock price increases furthermore to 1500, again this is a capital gain, but again there will be no capital gain tax on it because you still haven't sold your shares. Yes, if you would have sold your shares when the price was 1500, then the capital gain would have been realized and you would have had to pay the capital gains tax. So basically, one of the advantage that capital gain has that the tax can be deferred, and if you die without paying the capital gain tax, so you never sold your stocks and let's assume that you died, then even capital gain tax is not paid and it can be transferred to the next person without paying the capital gain tax. So basically it increases your wealth. If you're not selling your shares, it will increase your wealth and you would not have to pay the capital gains tax on it until and unless you sell your shares. Number two, the second point is that capital gain, the tax rate is actually lower. The tax rate is actually lower than dividends. So it is even the capital gain, the frequency of the capital gain tax being applied is less, and also even the capital gain tax itself is low. The rate itself is low. तो यहाँ पे कैपिटल गेन का अगर टैक्स के हिसाब से देखा जाए तो कैपिटल गेन इज़ एक्चुअली मोर बेनिफिशियल. एंड इफ somebody wants to avoid tax or if somebody is more interested in savings, then they would prefer that the payment comes in the form of capital gains rather than dividend deal. So this, I hope this is clear. So therefore that investors would prefer low payout firms. So they have argued that dividends are not good. They are saying that capital gains are good. Capital gains are good because it has a tax incentive in it. It is taxed less. The effective tax rate will be much less for your capital gain. So if the business is paying out more dividends, it is not a good thing and your stock price will actually go down. So this is what they are saying. They are saying that capital gains are better and the investor would prefer that to give them dividend in the form of capital gain instead of dividend. If you increase the dividend payout to them, more tax will be applied and your investors will be unhappy and the stock price will go down. So let's just summarize these three theories. this is the stock price over here, and over here you have the payout. So the first one, the irrelevance theory that we studied, the argument over there was that you can increase the dividend payout as much as you want. It will have no impact on the stock price. The stock price is 20, it will remain 20 whatever your payout policy. You can go from 50% payout to 100% payout, and even then the stock price will remain at 20. So basically they said it is irrelevant whether the return is coming in the form of dividend or capital gain. It makes no difference. Okay, so the irrelevance theory said that whether you're giving the return in the form of dividends or capital gains, the investors will be indifferent, because it's not difference, it's indifferent. Whereas the bird in the hand fallacy said that the dividends are more better. Dividends are more better than capital gains because dividends are more certain, whereas capital gain is an uncertain thing. It has more risk associated with it. So if the company is paying more dividends, then the stock price is expected to increase. So the bird in the hand fallacy um, supports that more dividends should be paid. Whereas the tax preference theory said that for dividends, the tax rate is more, the effective tax rate will be higher. So they said that the capital gains are better. So if the company is increasing the payout ratio, if they are giving more in the form of dividends, that would mean more taxes being applied, and the stock price will actually go down because the investors will be unhappy about it. So these are the summary of the three theories that we have done so far.